Alright, so I thought I'd do a recap of EU's price action yesterday. So it was quite interesting. It took both sides of the market, and in the analysis chats, I saw a lot of people were confused. Now I did take two entries off of this analysis that I did yesterday, and I thought I'd just share it with you guys. So starting off, this is the daily chart for EU, and we've come up. We've got bullish order flow. So we've produced a higher low, then a higher high, higher low, with the expectation of taking this high to then form a higher high again, but we've printed a higher low instead, reacting off of the money in this area. We've then come down, formed another higher low, at least for me, until it gets broken. This is a higher low. Going into the 4 hour time frame, we can see that the narrative for me yesterday was that we've had this massive impulsive move down, and then we've got on top of these highs a liquidity zone. So people may have been trying to short off of this with their stops above the high, maybe aiming for that low to get taken. Nice, lovely 3.5R. They've been taken out, so then going into the 15 minute. For me, what I was seeing yesterday coming into the charts was what we kept on doing is we're building here liquidity, building here liquidity. Yeah, so on here we're also building liquidity, then also on here we're building liquidity, and you see how price is just, so we've come down, build liquidity, reacted off of something in there, came down, failed to take this low, so this means this high is weak. We don't take the high, and then we take this again, and then we do the exact same thing again with the expectation of taking this high again because this low failed to break, doesn't break the high again. So what do we keep on doing? We keep on taking buyers stop losses and sending price further and further and further into discount. Yeah, we keep taking buyers stop losses. Yeah, so they have to sell their positions that were once expensive back to the market for cheap, meaning that the banks now have a large amount of orders that they can use to send price to the upside. So the narrative we're building here is we keep on taking the lows, which means we're wanting to take the highs. Yeah, obviously not when you're trending downwards in a bullish market, but in this sense, the narrative is we're taking the lows to then eventually take the highs. So we come down, reacting to something in here. Cool, fair enough. Price goes off of that. But the reason we've been, we've also been mitigating downwards like this, and we form some sort of trend line. People could have like a trend line like that, something along these lines. So if you were a retail trader, and obviously banks don't just function off of retail liquidity, that's not what I'm trying to say, but you would put your stop losses against above one of either these two highs. If you had shorted there, you would put it above this high. If you had shorted here, you would put it off this high or this high, maybe aiming for this low to get taken, who knows. Now what happens is price comes up, takes this liquidity, and then as soon as it's taken this liquidity, if you look, we've already taken most of this over here, so there isn't really anything over here for us to take, and we've also reacted off of this zone here. So apart from that, why would price want to go to the upside further after taking the available liquidity? You got to think about it, because now where's the liquidity? People are positioned underneath these lows. So coming into the 1 minute yesterday, I looked further back, and I'm not POI trading. I'm just trying to build the narrative once again. But if you look here, we have taken the money from this range, drops down inefficiently, comes back up, fills price, mitigates off of here, money goes from here to here, here to here, here to here. This comes up, doesn't mitigate out of this candle. So the last place that price would want to mitigate would be this point here. So that basically justifies taking a trade off of this zone. Now, I don't POI trade, but I do look at points in price that may have printed, I don't, let's say 4 hours ago, 8 hours ago, 12 hours ago, a day ago, and I keep them in mind because if I know that if I'm in the edge of the range and if price is coming up to a previously unmitigated POI, if I take one loss on that, I don't really care. So I use these points not as like the overall like confluence for why price is going to drop from this zone, obviously using the liquidity and other things and just general market structure, but knowing that this is pretty much the last point that price would want to get up to before dropping. So using that narrative, yesterday, this wasn't yesterday, that was the other day. Yesterday, using that narrative, I'll just put these to where my take profit actually was. So my take profit was here. I only needed these two trades to pass a challenge yesterday, so I didn't really do much else. But coming into the 15-second, what we see when we, oh, God, scrolling such a bitch. Coming into here, what we see is I have two entry models that I use. So firstly, you've got the classic phantom style entry, which is you range, you come out your range, you come back up to mitigate the 50%, then you drop off again. Fair enough, pretty simple. But my other entry style that's pretty much been popularized by Albert and Sketchy is this one where you don't wait for the mitigation, you just put a sell stop on this low and a stop loss on the high, and as soon as price follows through, even if price doesn't come up and doesn't mitigate out, you're still filled into your position. So when you're in the edge of the range, price can move with a lot of momentum really quickly, and sometimes you can't get into those entries because price is just moving so fast that it doesn't come back up to mitigate you, and this can cause frustration for me in general, that I build the narrative and then I place my entry and wait for a mitigation. That mitigation never happens, and the next thing you know, I'm rubbing my hands watching my perfect analysis play out on the charts in front of me. So for me, I know in the edges of the range, which is where this is, that using the sell stops or the buy stops is the best option because you're going to get into that trade when it happens and you don't have to wait for that mitigation. So reason I took this trade, come back into that final point. For me, this is protecting the highs, failing to break further. So as soon as this happened, drew on this low, stop loss above the high safely, bang, already explained it. That's why I'm in that entry. Now, just to further clarify my point, you wouldn't have gotten in on mitigation of this because it never came back up. You wouldn't have gotten a mitigation of this, never came back up. If you're looking on the 5 second, there might be something in between these two wicks, but who knows, still didn't come up to meet it, so you wouldn't have got in on that. You could say between these two wicks, no, didn't come up to meet that. Between those two, no, didn't come up to meet that. Came, broke the low, came back up, started to protect the highs again. Here. So for me, that was my range. So if we break the low, stops above the high. I was going to place a sell stop here, but I ended up just market executing because I was like, I don't see price going above these highs, and if it does, I can always get an entry off of this point here or this point here. Why I chose my target where it was, firstly, that's what $2,000 looks like on a fund in talent, so I only needed to go to there. Secondly, if price was going to then go up and not respect my last POI, that would mean that my narrative is completely destroyed, so I wouldn't want to be in the markets anyway. But you can see that I was sort of going for this order block here. If I wasn't in the challenge phase of my account, I would have held to the next week low, which is the next week low for me in price would be this point here. So I would have held it to either meet the week low or either to break the week low, either or, it doesn't really matter. I mean, if price is coming to test the low or break the low, same sort of thing. So I usually do it to meet the low. But that was pretty much the overall narrative for EU yesterday, at least for me. Both these trades were taken on my account. Yeah, it's pretty simple. I do want to stress though that after watching this video, you shouldn't go ahead and start going so in depth into liquidity. It's more of a confluence than a reason to enter. You're just using it to build narrative, because next thing you know, like, you're thinking to yourself, alright, okay, well, on here there's buyers and on here there's sellers, but then also on this side there's buy stops, and then also on this side there's sell stops. So both sides are packed with liquidity. Why does this not get taken? And the next thing you know, you're confusing yourself with your entries. Like, just use it as a, we've made a strong high and we failed to break that strong high, so that means the next week low is going to get taken. Is there liquidity supporting that direction? Yes. Should I enter a trade? Yes, because as soon as you start getting into liquidity and using it as your overall reason to enter in the markets, you just sort of start to get mucked around. So I was about to say, I hope everyone enjoyed that video. Pretty short one, but yeah, I was about to say, cheers.